Hi everyone, good evening. My name is Dhaval Kapadia and I head the investment management for Morningstar in India. And this evening I'll be talking a little bit about Morningstar's views on the union budget that was announced earlier today. Clearly this is a budget that seems to be trying to appease major sections of the voter base, including farmers, workers in the unorganized sector, the salaried middle class, and even the business owners. Overall, it appears to be a budget that would boost consumption. Talking a little bit about the key proposals from the budget. For farmers, the government has come up with a minimum income kind of a scheme. So they've promised about 6,000 rupees per annum, which would be provided for farmers with land holdings of up to 2 hectares. And this would be in the form of a direct cash transfer to the bank accounts of eligible farmers. And in fact, the first installment of this benefit would be paid out to farmers, for the quarter of March 2019 as well. And it is estimated that around 12 crore families, would benefit from this. For the unorganized sector, the government has come up with, a pension plan for workers in this sector. So essentially, people right from street vendors to, rickshaw drivers to construction workers. Would sort of benefit from this, pension plan as such. Coming to the middle class and the salaried sort of income or the salaried sort of class, the tax rebate for individual taxpayers having annual taxable income of up to rupees 5 lakhs has been increased from 2,500 to 12,500 rupees, which would essentially result in a nil tax being paid by such taxpayers. And in fact, for salaried persons, overall the standard deduction has been raised from the current 40,000 rupees to around 50,000. In fact, of all the benefits under ATC, the additional NPS benefits, the medical insurance, and the standard deduction of rupees 50,000 are considered, an individual with an annual income of 7.75 lakhs per annum probably wouldn't be required to pay any tax at all. In addition to these benefits, the government has tried to boost the flagging real estate sector as well, and a few benefits have been announced for this sector. One of them is that a taxpayer having capital gains up to 2 crore rupees, the benefit of the rollover of capital gains will be increased from investment to 2 residential houses from the current 1 residential house. This benefit can be availed once in a lifetime for an investor. Another sort of benefit on the real estate side is that income tax on notional rent currently is payable, if one has is currently payable on more than one self-occupied house. So if you own more than one self-occupied house, you need to pay income tax on the notional rent. The budget is proposed to exempt this notional rent on a second self-occupied house as well. So this is again, positive sort of for investors in real estate and for the real estate sector as a whole. Overall, if we were to sort of look at the budget and more specifically what our views are, like I said earlier, probably the budget would boost consumption both in the rural and the urban sector, due to benefits such as the direct cash transfer to farmers, the income tax rebates, and the real estate sort of benefits. This boost in consumption would tend to be inflationary as demand would tend to increase. So, that's something that we'll have to sort of keep in mind. Secondly, these measures have also contributed to an expansion in the fiscal deficit for both, FY19, because some of the direct cash transfer benefit for farmers is being started from this financial year itself, the current financial year, and therefore it would impact the fiscal deficit for FY19 as well as for FY20, and the estimates have been increased to 3.4% for both these years. And in fact, in our view, clearly these estimates seem a bit optimistic. And they include strong growth estimates for GST and income tax collections, and the government's estimates for disinvestments also seem a bit difficult to achieve, given the trend in recent years. So overall, we think that there is a risk that the government might exceed these fiscal deficit numbers that they've put out, and they may have to resort to either additional market or non-market borrowings. If you look at how markets responded to the budget today, equity markets ended the day positively, but the bond market saw yields sort of move up by about 10 basis points, with the 10-year GSEC closing at about 7.38%, probably on concerns of a higher fiscal deficit. Clearly we believe that over the short term probably markets would tend to track some of these near-term events like the upcoming general elections, RBI action, and probably what's happening in global markets. But over the medium term, to long term, we clearly believe that fundamentals would rule. Although India's growth prospects are reasonably positive, with better macros in terms of lower inflation, reasonably contained current account deficit, assuming that oil prices remain within the current range and don't spike up once again, we clearly believe that current equity market valuations appear to be sort of adequately pricing these positives, thereby reducing our long-term return estimates from the equity markets. Broadly we expect Indian equities to generate an annualized return of around 8% over the next 10 years or so. Within the broad equity basket, we believe that Indian sort of large cap stocks look relatively more attractive as compared to small and mid caps. So small and mid caps still look a bit overvalued, although the recent correction has resulted in the overvaluation moderating a bit. Accordingly, in our model portfolios, we are currently sort of underweight equities, particularly mid and small caps, and overweight cash and short-term bonds, vis-a-vis our neutral allocations per se. Within international equities, we are currently sort of underweight US equities and have a positive sort of outlook on UK and emerging European markets as such. Coming to the fixed income side, we think that yields are looking fairly attractive, particularly at the shorter end of the curve, with spreads over government securities currently trading above long-term averages. However, we believe one needs to be mindful of the current stress in the credit market and probably stick to AAA rated or good credit quality rated short-term corporate bonds and bond funds from a risk and return perspective. Overall, we would advocate investors to follow an asset allocation approach and build an asset allocation that's aligned to one's risk appetite and investment horizon, and probably not get too swayed by short-term market noise and market volatility. That sort of sums up our views on the budget and the markets as such. Thank you for watching.